The rich pay less than you. Why the tax code rewards wealth over work. This is Warren Buffett, tone of the richest people in the world. He's not flashy. He still lives in the same house he bought in 1958. He drinks Coke, eats McDonald's for breakfast, and yet is worth over 100 billion. How? Warren Buffett runs Berkshire Hathaway, a company that doesn't make anything. It owns things. It's what's called a holding company. Through Berkshire, Buffett owns big businesses like Geico, the insurance company, BNSF Railway, one of the largest freight rail networks in North America, and even Dairy Queen. But it doesn't stop there. Berkshire also owns massive amounts of stock in companies Apple, Coca-Cola, American Express. Here's how it works. When those companies grow and their stock prices go up, Buffett's wealth goes up too because he holds so many shares. Back in 1965, when Buffett took over Berkshire Hathaway, one share cost 19. Today, that same single share is worth nearly 500, zero. And Buffett owns almost 440 null shares. That's more than 100 billion tied up in just this one company. But here's the twist. Despite being one of the wealthiest people in human history, Warren Buffett has said publicly that he pays a lower tax rate than his secretary. That's not a joke. He's serious. He's even said, "She pays twice the rate I pay." I think that's outrageous. And it is outrageous until you realize how the tax system actually works. Because Buffett doesn't earn his money like most people. He doesn't get a salary, he gets capital gains from his investments. And that's where the loophole begins. So why does Warren Buffett pay a lower tax rate than his secretary? It all comes down to the type of money they make and how the government taxes it. Buffett's secretary earns a salary. She works a 9-to-5 job and gets paid regularly, just like millions of people around the world. That income is taxed by the government using a progressive system. In the US, that means the more you earn, the higher your tax rate, up to 37%. Now let's look at Buffett. He doesn't take a big salary from Berkshire Hathaway. In fact, his annual paycheck is only about 100. But that's not where his money comes from anyway. His real income, the billions, is from capital gains. What are capital gains? It's the money you earn when you sell an investment for more than you paid. For example, if you buy Apple stock at 100 and sell it at 300, that 200 profit is a capital gain. Now here's the kicker. Capital gains, especially long-term ones, are taxed at a much lower rate than salaries. The maximum tax rate on long-term capital gains is just 20%. Compare that to a high-income earner paying 37% on their salary. That's why Buffett's secretary, earning a normal wage, may be taxed at a higher percentage than her billionaire boss. And Buffett's not the only one. People like him, investors, CEOs, hedge fund managers, tech founders, often make the bulk of their income through investments, not salaries. So they legally pay lower tax rates than nurses, teachers, or office workers. This isn't a glitch in the system. This is the system. And the richer you are, the more this system works in your favor. Because the wealthiest people in the world have learned this simple truth. Earned income gets taxed hard. Investment income does not. And that's the foundation of the tax gap between the rich and everyone else. Over the last 40 years, something strange has happened. The top 1%, the richest people in society, have seen their after-tax income rise by over 400%. The middle class, their income has grown just 50% in the same time. It's not because the rich work 8 times harder, it's because they make money differently. Most people earn a wage or salary. They go to work, get paid every month, and pay income tax on that money between 10% and 37%, depending on how much they earn. But the ultra-wealthy don't rely on jobs. Their money comes from owning things. They own stocks, they own real estate, they own companies, they don't clock in. Their wealth grows quietly through capital gains, dividends, and rising asset values. This is where the gap begins and where it keeps widening. Meet Morris. He used to work on Wall Street. Now retired, he lives comfortably off the stock market. He owns shares in companies like Berkshire Hathaway, Amazon, and Apple. When those stocks go up, so does Morris's wealth. And when he sells them, he pays capital gains tax, often just 15 to 20%. Compare that to someone earning £50 a year from a regular job, who might pay closer to 30% when you add up income tax and national insurance. Morris says it himself, "I pay less in taxes than people who work full-time and make as much money as I do." He's not hiding it. He's pointing out the flaw. It's legal, it's normal, but it's also deeply unequal, because most people don't have portfolios. They have paychecks. and they're taxed more while being told to work harder to get ahead. But how do you compete with someone whose wealth grows while they sleep? This is the structural divide in modern economics. The rich don't just have more money, they have access to different money, the kind that grows faster and is taxed less. And that's how, decade after decade, they keep pulling further ahead. Morris recently sold some stock for £400, zero. His total tax bill? Around 50, zero. That's roughly 12.5% of what he made. Now imagine someone else earned that same £400, zero through a salary at a high-paying job. Their tax bill would be much, much higher, well over 150, zero once income tax and national insurance are added in. Why the massive difference? Because of how the system treats stock versus salary. A salary is taxed as you earn it. Paycheck comes in, taxes go out. It's automatic, unavoidable, and constant. But stocks? That's a different story. You don't pay any tax while your stocks rise in value. You only pay when you sell. That means Morris could buy £100, zero worth of stock, watch it grow to £1 million over 10 years, and pay zero tax as long as he doesn't sell it. His net worth rises, his wealth grows. But there's no tax bill in sight. That's not a loophole. It's the law. It gets even better for him. Because when he finally does sell, it's taxed as a capital gain, which is typically 15 to 20% far lower than income tax rates. So the system isn't just delaying taxes for the rich, it's also discounting them. Even more, many wealthy people like Morris choose not to sell their stocks at all. They borrow against their portfolio, taking out loans using their investments as collateral. That means they get spendable cash without triggering a tax event. No sale, no tax. They can live comfortably, fund projects, even buy home stacks free. Meanwhile, people who work 9-to-5 jobs pay tax the moment their paycheck arrives. The system rewards ownership over labor. And it's not by accident, it's by design. The richest households don't need income. They already have assets that quietly build value. And as long as they don't sell, the government doesn't knock. That's how the rich stay rich and why the tax code continues to favor wealth over wages. There's a quiet strategy the ultra-wealthy use, and it's perfectly legal. It's called buy, borrow, die. Here's how it works. First, they buy stock, lots of it. Over time, the value of that stock increases. But instead of selling it, which would trigger capital gains tax, they borrow against it. They take out low-interest loans, using their growing stock portfolio as collateral. This borrowed money can fund their lifestyle, buy homes, yachts, cars, donate to causes, even invest in more businesses. And because it's a loan, not income, it's not taxable. No sale equals no capital gains equals no tax. Elon Musk has famously done this. So have many other billionaires. They live on loans, not wages. Now here's the final step. Die. When the wealthy pass away, their heirs inherit the stock. But here's the trick. The value of the stock is reset to its worth on the day of death. This is called the step-up basis. So if the billionaire bought stock at £10 a share, and it's now worth £1 a share, those £900 and 90 gains, never taxed. The heirs can sell the stock immediately and pay little to no tax. Generational wealth passes on, tax-free. This isn't a backdoor loophole. It's written directly into the tax code. So while everyday workers pay income tax year after year, the ultra-wealthy delay, discount, and often delete their tax bills altogether. Buy, borrow, die. That's the strategy. And it works perfectly. Most capital gains, the profits made from selling stocks or other investments, don't go to the average person. In fact, over 75% of all capital gains go to the top 1%. That's why many lawmakers believe reforming how these profits are taxed is an obvious step toward fairness. President Biden has proposed two major changes. 1. Raising the capital gains tax to match income tax for millionaires up to 39.6%. 2. Closing the step-up basis, loophole the rule that lets heirs avoid taxes on decades of untaxed gains. Under Biden's plan, people who make over £1 million annually would no longer enjoy a lower tax rate just because their income comes from stocks. And families couldn't just pass down untaxed stock wealth forever. Supporters of the plan say it would raise between $200 billion and $400 billion in tax revenue over 10 years. They argue it's a way to make the system more fair, so the ultra-wealthy pay something closer to what everyday workers pay. But not everyone agrees. Critics warn that higher taxes could discourage investment. Wealthy people might sell less stock or hold assets longer to avoid tax altogether. Some say it could hurt small businesses or retirees who rely on investment income. Still, public opinion is strong. Most Americans believe the rich should pay more. The question now is whether the political will can match the numbers and whether closing these long-standing loopholes is really possible in a system where those who benefit most often hold the power. Across the board, one belief is growing louder. The rich don't pay their fair share. This isn't about jealousy, it's about justice. When billionaires pay lower tax rates than teachers and nurses, people know something is off. Fixing capital gains won't solve inequality overnight. But it's a place to start because that's where untaxed wealth hides. In stocks, in property, in inherited assets, passed down untaxed. More ideas are gaining ground. Wealth taxes tax not just income, but assets. Stocks, homes, art. Critics say it's radical. Others call it overdue. Mark-to-market taxes tax investments as they grow, not only when sold. No more waiting decades to contribute your fair share. To people like Morris, the retired investor, these ideas make sense. He says, if the middle class disappears, so do customers. So does the economy. It's not a war on wealth, it's a call for balance. Minute 15. Ending moral. The tax code tells a story. The tax system sends a message. To workers, pay now. To the rich, pay, maybe. This isn't neutral. It's a story about who we reward and who we expect to carry the burden. Reforming capital gains is about responsibility, not revenge. It's about building an economy that works for more than just the top 1%, because this isn't just Buffett's story or Morris's, it's everyone's. Moral lesson: wealth isn't what you earn, it's what the system lets you keep. To fix inequality, we must stop taxing work more than wealth. Subscribe for real economic stories. Follow for honest takes on money, power, and fairness.